time to our Economic Update webcast. I will be the moderator for today's event, and as always, our goal is to continuously add value for our clients by helping to educate you and keeping you up to date and informed. Today's discussion will be hosted by Roy Williams, CEO of Prestige Wealth Management Group, John D'Angelo, Managing Director of Prestige Wealth Management Group, and Paul Esposito, who serves as our Senior Portfolio Manager. This conference call will be in the listen-only mode and should last approximately 30 minutes. No participation is required, and there is nothing you need to do. Just sit back and relax. We will take care of the rest. We cannot take any live questions during this call, but we do welcome your comments and suggestions. So at the conclusion of the conference call, please feel free to send us an email with your comments and or questions to pwm@prestigewmg.com. And with that, here's Roy.
Welcome, everybody. We thought this was a very, very appropriate title to recession or not to recession. That's the question. We've been getting a lot of questions from clients, and we want to make sure we answer these questions as best as we can, and we figured it best to do it during our economic update. So first off, we start out by looking at the, what is the capital markets and the global economic outlook. Last year, John, when we look at, going back to the last quarter of last year, December, we were discussing that the other day. What was December?
Right. December was actually the worst December we've had since 1931. It was actually a worse December month than we had in 2008. So yeah, it was a difficult quarter.
Yeah, and we discussed some of the reasons, Paul, why December was so bad. When we had the tax cuts, we had the economy growing. Why don't you discuss that?
Yeah, no, absolutely. I mean, I think it all comes down to one offender. It's the Federal Reserve. I know a lot of our clients are probably sick of us talking about the Fed, but they have taken the stage for most of last year. They continue to take it for this year. Obviously, the Fed raising rates in light of an economic slowdown or slowing economic conditions abroad did roil markets in the fourth quarter. Of course, Jerome Powell saved face, and they changed his entire tone to not raising rates for this year and actually reducing some of that balance sheet unwind, which was a bigger cause for concern. And voila, right? Markets have done a complete U-turn.
Yeah, I'd take it a little further. It was a complete reversal. From getting 2 to 3 rate increases to, getting no increases, from continuing to get the assets off the Fed's balance sheet and to, holding tight. We were the only economy in the world that was raising rates in the whole world. When we look at earnings, John, what was the big push in earnings last year? We've seen this chart. 20 to 30% earnings growth last year. A lot of people really don't understand how earnings growth could increase that much. Why don't you talk about that for a second?
One of the major catalysts for earnings growth in 2018 were the Trump administration tax cuts. So those tax cuts pushed a lot of earnings up, forward, pulled earnings forward. So earnings growth was extremely strong in 2018. If anything, we might be experiencing an earnings hangover going forward because the comparable data from last year is so strong.
Yeah, and the corporate tax cuts, and I know we spoke about that. We had the second highest tax rates in the world next to Japan, and unlike Japan, a lot of U.S. corporations were allowed to hold assets overseas, and we weren't collecting taxes on hundreds and hundreds and hundreds of billions of dollars annually. So that was part of the reason. And both the Democrats and Republicans agreed on corporate tax cuts. It was just agreeing on a percentage, Democrats and Republicans. Even under President Obama, they proposed corporate tax cuts. So when we look at Paul here at the earnings growth, in the United States, let's look at global economic growth. And the global economic growth, why don't you talk about that a little bit?
Sure.
The PMI.
Right. So I think it's fair to say that, the U.S., the earnings growth story, we're going into a slowdown. The leading economic indicators that we follow, there's a Conference Board 10 leading economic indicators that we follow. For this past quarter, they're still increasing, but not at the pace that they were for the previous year. We cited, obviously, the hangover for, tax cuts as being the primary driver. Obviously, trade uncertainty being another. So if we look at things from a global perspective now, Purchasing Manager Index is basically a health index for expansion or contraction. Any reading above 50 is a healthy manufacturing or service-based economy. Anything reading below 50 usually portends to contraction in those economies. So the dichotomy here is the service-based economies, as of at least the end of February, started to actually trend higher, right? So we're at 53.3, whereas manufacturing-based economy, the dark gray line, is sort of at the crossroads between expansion and contraction, right? At flatlining about 50.6. That trend ensued from the end of last quarter, all the way up until this year. And again, not to be redundant, it really stems from trade uncertainty. There's a lot of anecdotal evidence with auto manufacturers having to reset inventories and shift manufacturing from China and so forth. So that has been a drag on a lot of manufacturing-based economies. But I think overall, it's fair to say that there is a potential for, and we just with the PMI numbers that we saw yesterday, last night coming out of Europe, that very well could be bottoming. The risks to that are obviously if the trade deal doesn't get solidified this year, that we could see that trend lower. But the moral of the story is, when we look at that in aggregate, we're still in expansionary territory. Looking at GDP growth, again, the trend is starting to weaken. We're still growing. We're slightly below what the 15-year average has been. And again, a lot of that is that the trend in that figure is attributed to the trade talks as well as within the U.S. tax overhang.
Yeah, and if you look in at the chart, there's been multiple times that the growth has dipped below the trend line since the expansion started in second quarter of 2009. That's happened many times. And one thing when you look at global growth, when I'm hearing from clients, knock on wood, I haven't had to buy a new washer or dryer, but they're paying $100 or $200 extra for washers and dryers because of tariffs. Only people buying washers and dryers are the people who have to replace them right now. It does cause, from an economic standpoint, to people not spend as much money because they help. Again, people are countries, people, and corporations are individuals and corporations are waiting to see what happens with the tariff deal. So it's going to be interesting as we move forward this year. And looking at emerging markets, one thing to understand about emerging markets, the opportunity and reward goes with significant risk. So, John, from a valuation standpoint, emerging markets look compelling, right?
Yeah, I think most of our clients, when they thought of last year, it was just the fourth quarter where they saw, U.S. companies or U.S. markets decline. But, when we look at the global markets and we look at emerging markets in particular, emerging markets were down 20% while U.S. markets were up. So from a valuation standpoint, emerging markets right now are priced at a very compelling price point. And, if you think about it from a price to book value, right now they're trading at 0.51 to the S&P 500, and that is well below their averages.
Yeah, and last year the U.S. markets ended up down, but there were certain points where the U.S. markets were up 6-8%, and emerging markets are down close to 20%. But for the year, because of what we discussed early in December, the U.S. markets, had significant down years depending upon small cap, large cap growth value, what asset class you're in. As we move forward, Paul, economic expansion, this comes up all the time in, discussion of recession probability is, we've been through this long expansion. Why don't you discuss, expansion?
Yeah, absolutely. So, this current expansion is, about 117 months or almost 10 years old. It'll actually be the longest running expansion prior to the 1990 to 2000 expansion. If we continue on in growth phase until June of this year, which will be fairly remarkable. So I think that the big takeaways here, if you look at the number, the expansionary periods on average versus recessionary periods, just within the last 50 years, notice expansionary periods have been a lot longer on a ratio-wise relative to recessionary periods. So I think that's a very interesting takeaway. But, we get a lot of calls of concern saying, well, this has been, the second longest expansion on record, that this expansion is going to have to come to an end pretty soon. Bull markets, the proverbial bull markets don't die of old age. I think there's a lot of credence behind that, especially when looking at the level of GDP growth that has been attained during an economic expansion. So the chart to the right that shows for each growth period what percentage of cumulative GDP growth has actually been attained. As you can see, we've only amassed 16% ish of cumulative GDP growth. So it's the light blue line all the way to the bottom, and that was done over the course of 117 months. Compare that to some of the other cycles that we've had. Now, of course, they're not all going to be the same. Obviously, there's different contributing factors to economic expansion, but the velocity and breadth of GDP growth was much higher in those. It's fair to say we're in a very low growth environment. Interest rates, not only here but globally, are very low. So, that there is a potential for this current economic expansion to last a lot longer than prior ones, just because growth is very, very slow. On another point, Roy, just with the inversion of the yield curve this past month, I know that that's been a topic of interest. Many individuals have always looked at that as a key indicator to recessions. So, we wanted to maybe take a little bit of time and talk about, the importance of the yield curve and what that actually means.
When we look at the yield curve, it inverted for a week. What that means is the 2-year Treasury was yielding higher than the 10-year Treasury, and it happened for a week. And John, a lot of times in the future, it'll predict a recession, but the hard thing is timing, right?
Right. I mean, just because the yield curve inverts doesn't mean that a recession is coming on in, a week or a month. Sometimes it's just a predictive measure that there could be a recession over the course of a 12 or 14-month period.
Or even 3-year period.
Right, and the reason for that is pretty simple. Banks borrow short and lend long, and if the rates, the long-term rates are lower than short-term rates, then banks don't really have any type of incentive to lend. If they don't lend, then, liquidity and credit tightens, and companies don't have the money to get that lending in order to create more growth. So, what ends up happening when that happens sometimes is that it could create a recession. So that's why there's some fear around, inversions of the yield curve, or concerns, I should say.
And Paul gave me the pleasure of having dinner with, there's only less than 30 people at dinner, with a very world-famous economist, Jeremy Siegel. And, he basically gave me a history lesson. During the 50s and 60s, from a yield curve standpoint, the spreads were very, very narrow for 2 decades, meaning 25 to 50 basis points. So, again, to predict when a recession happens, how a recession happens, is challenging. At the end, somebody's going to say they were right. When I was at the Forbes conference, the end of February, beginning of March, they had every major economist from Merrill, from Jeremy Siegel, who's from Wharton School of Economics, from London School, all these economists, UBS, you name them, they were there. And the funny thing is, when everybody's predicting, and, John Paul, we were talking about this before, everybody had a different opinion. Is it 2020? Is it 2021? Is it 2022? It's very challenging to pick a point in time of when it's going to happen, because there's so many cause and effect situations. A trade deal not happening is a tailwind, which will pull back on the economies of the world. A trade deal happening could be a headwind. So, when you're looking at all the factors that go into an economy, corporations holding back spending money, and then corporations spending money if we get a trade deal. There's so many factors, it's very, very challenging to predict the when. So if you have all these PhDs from top schools like MIT, Harvard, Chicago, to name a couple of them, all of them have different opinions and reasons for those opinions. So, we want clients to be very, very careful in trying to time the recession perfectly, because nobody will time it, and sometimes they'll make a fool out of you. There's been a time where we didn't have one, where everybody was predicting one. So this is something that, we are going to stay on top of, and as we move forward. But let's talk about the U.S. yield curve inversions, in recessions, a little more, Paul, in terms of.
So what I think is an interesting takeaway, Roy, for the very brief period from March 22nd to that week. The only part of the yield curve that inverted was the difference between the 3-month and the 10-year Treasury. There have been other portions of the yield curve that economists look at as a better leading indicator. There's always a fruitful discussion over which one's better: 3-month, 10-year, 2-year, 10-year. A lot of economists use the 2-year, 10-year spread. And this chart basically shows when the onset of a recession occurs after a 2-year, 10-year inversion occurs. Normally, they occur, at the same time. If the 3-month and 10-year curve inverts, usually the 2-year, 10-year curve inverts as well. We didn't get that this time. Again, not to be guilty of saying this time it's different. There are some very considerable factors that we need to look at, namely the influence of central banks on interest rates. But again, getting back to this chart, if we just look at the time frame, the lead time to an onset of recession, on average it's been about 14 months. And traditionally, markets peak about 8 months on average after that point. So again, not to paint a rosy picture, but just to say that, from the time that the yield curve inverts, that it's time to panic and get out of the markets, that's not necessarily the case. And in this instance, we really haven't seen a 210 inversion yet. And again, one metric like the yield curve is useless when not factoring in all the other corroborating evidence. Looking at today's unemployment numbers, looking at wage growth, it's not telling a story of a recessionary environment at this juncture.
Yeah, and when I look at, in 1980, I was taking my investment class in college, and, unemployment also, I've not seen a recession in 88, 89. We always see unemployment tick up significantly, which we've not seen unemployment move. So could that be different this time? Yeah, that could be different this time. But again, unemployment, I'm still, John and I were talking about, I'm still seeing clients, a lot of clients be able to get very good paying jobs or very, very good consulting situations. So, that's a little different. We're not seeing weakening employment numbers. We're actually seeing, decent wage growth, right, Paul?
That's correct. And, we are being very mindful of any of the economic data that starts to deteriorate. Like we said before, we are seeing, a slowing in growth of earnings. There are some economic indicators out there that, are starting to slow. If we look at just the gap between unemployment and wages, we're keeping our eye out for a divergence in that pattern. If you've noticed, they're very close to one another, right? Wage growth is rising. Unemployment is pretty much staying on pat at 3.8%. If we start to see those moving away, then, that, again, is more corroborating evidence for why maybe the inversion that occurred back in March is, something that...
For the 3 months.
For the 3 months.
But again, the 210 hasn't occurred yet.
Correct. And looking at the influence of central banks, you bring up a very good point. Yield curve as indicators now are very distorted. If you look at other developed market economies, namely Japan. Now, Japan is engaged in quantitative easing for, the better part of 20-plus years. The last few recessions that they've had, there has been no yield curve inversion.
Well, I think the point is that, if there are multiple indicators that we look at every single day for our clients that start to show that type of weakness and start to confirm that we have a higher probability of the onset of recession, there are several things or several steps that we may take as a firm.
I think clients need to be aware we've already taken one step, because for corporate bonds, it didn't make any sense to have our risk elevated in corporate bonds, because we look at the past 2 recessions, high-yield corporate bonds lost, I'm thinking back to even 2002, lost over 30% during the financial crisis, depending upon the type, they lost more than half. So we're very mindful of that and protecting our clients on that side by moving up our quality. So again, this is a step process we're talking about in terms of, where to protect and how to protect the best we can. Because like I said, I had these experts one at a time coming from and center, and, one's going to be right at some point. But again, there's lots of different opinions out there, and we want people to be mindful and not make a decision based on something they hear on CNBC or something they read in the paper. Because if you had made decisions based on what you're reading in December of this year, at this point it was a very bad decision, where we bounced off the bottom over 20% on the equity side. So again, we want to be very mindful of there's a lot that goes into it, and we're going to stay on top of it as best we can.
Yeah, no, I think a great point that you make about, CNBC is I think the end user, our clients, when they turn on the television set, they sometimes forget that the point of these TV stations is that they want eyeballs on their station. So when things are great, they tell you it's too great or super great. And when things are bad, they tell you the whole world's coming apart. But most of the time, it's neither.
Right. Yeah, they're I've been on there many times where they asked me to be a bull or bear and give the thesis of that situation depending upon where we were. So, yeah, without question, I agree with that. If we look at the Fed, and if we showed last year's chart in terms of, projections of expectations of interest rates, this just shows you the projections are always wrong. They were projecting well over 3% interest rates for last year. And Paul, right now, we have a pretty low interest rate environment.
We are. I mean, the Fed has, indicated that and the market is pricing in the fact that we're not probably going to see any more rate hikes this year. The unwinding of their balance sheet is set to expire in June, so we're not going to see any more Treasury sales. That's going to be a good environment for equity prices.
So, and as we discussed earlier, that was a concern. As in the U.S., the global central banks purchased debt, various types of debt, for liquidity purposes and for keep their economies moving purposes. The global monetary policy, Paul, what do you think of that right now?
Well, we've used this chart in the past, and essentially what it does is it gives us a pulse of global liquidity. Obviously, the total is the orange line. So liquidity increasing as they're purchasing bonds, going upward, or is it decreasing? And to the tail end of last year and what was anticipated to be much of this year was the Fed reducing their balance sheet. As you notice in the dark gray, that's what were the tentative sales of the Fed's Treasury and mortgage-backed security balance sheet. So they've sort of kicked the can in pushing out those sales. Actually, they'll be stopping those sales. And so now we're at a point where we might actually start to see within the next year or so more global liquidity.
In China, everybody, the China trade deal. One nice thing that I saw, I think it was 2 weeks ago, when you have the Chinese vice president come out and says copyright infringement is a problem. Sometimes you have to admit something before you can fix it. And that was the first time, John, I've publicly heard them acknowledge that, them stealing intellectual property is a problem.
Yeah, I think both sides are starting to become motivated to get to an end game. Both the administration here and also I think China. It would be beneficial that they come up with some type of a solution sooner rather than later at this point.
Right. I mean, people forget that we're more than half of China exports. So the tariffs, in there, I think the number is 14% for us. So the tariffs hurt them more than it hurts us. So, but again, Europe, the leaders in Europe and all the leaders in the U.S. concur. They cannot. When they were a small economy, stealing intellectual property may have not been a big deal, but they're by far the second largest economy in the world, and eventually, just by demographics, will become the largest economy in the world in the next few years. So, hopefully everything works out, and they're progressing, which is very positive. So, keeping the long-term perspective, I know we always talk about, keeping a long-term perspective because it's very challenging. So when we talk about a long-term perspective, if somebody needs money to buy a beach house, if someone needs the money for a college education, the majority of that money should be in cash because that's not a long-term perspective. 6 months or a year, John, right? As financial planners, that's short-term and should be in cash, CDs, or liquid for the available use. So, we just want to keep that in mind. Even 5 years is not long-term. Let's not forget, John, in 2000, from 2000, it took the NASDAQ, I think, till 14 or 15 to hit new highs, and it took the Dow till 13 to hit.
Yeah, I mean, I think in wealth management, financial planning speak, long-term, you have to get outside of the average business cycle. So right now, think about it, a business cycle, this past business cycle is 10 years long. So if your goals and objectives for that money aren't, around 10 years plus out, then, you can't really be taking risk with that capital.
Right. Yeah, unless you have so much money. We have a client that the dividend income is well into 6 figures, and between pensions and Social Security, it's 200,000. That's not. Those people can take more risk because they don't need to touch the money. But most people aren't in that position. So in looking, equity performance around bear markets, John, that's why it's very dangerous. If we look at this chart, it's very dangerous to try to predict, because if you're wrong, if you look at 12 months before the bear market happens, if you're wrong on that side and become too conservative, it infringes on your ability to meet your financial plan.
Right. I think the really important thing about this chart is that, being tactical with your money and maybe being a little underweight equity versus fixed income is one thing. But the let's cash out of a portfolio because I'm worried, or, hey, everything's great, I want to buy all stocks with my portfolio. If you take that approach, the amount of risk and the potential of capital loss is extraordinary.
Oh, yeah.
I think, John, to your point, I think the chart does a great job in highlighting 2 points. One is that time ultimately does heal, right? So if you look at the aftermath after, a bear market ensues, what the rate of returns are after an equity market peak, right? So 14 months, 12 months later, you look 2 years later, obviously it's still a negative return. Brings credence to the fact of being a long-term investor. The other point, in looking at, when market prices are extremely high or extremely low, and this is always a difficult, conversation that we have with investors, is not feeding into too much exuberance, right? So when markets are up 20, 30%, from a low, sort of, asking yourself, is now really a good time to increase risk in my portfolio? Conversely, when the market, case in point, December of last year is, at at least a cycle low, is now a good time to reduce risk. And no, it's usually the opposite. So that's, I think, part of the exercise.
Yeah, and that's, part of, having a long-term strategy and making sure that if you have liquidity needs, that the money is not invested, meaning if you're buying a new car for $75,000 or $90,000, that money should be in cash. That's going to happen in 2 years. I'm ordering a car, that money should be in cash and not invested. And risk management, and we do that as a team from a financial planning standpoint, making sure that the portfolio matches the financial plan in terms of the balance that you should have. And looking at rebalancing opportunities. If the market drops significantly, that's also, a great time to buy. And conversely, if the market's up significantly, it's a great time maybe to take some off the table. Clients, in the first quarter who needed, significant money, from their portfolio, we basically rebalanced and took some off the table, from a standpoint. If the market was down, conversely, maybe not best time to sell equities. Last year, we were very selective in the last quarter, making sure towards the end of the quarter not to sell significant equities for distributions. So again, there's a lot that goes into this, and our job is to stay on top of it. And as a team, John, Paul, myself, Michael, Alyssa, everybody involved in the investment committee, we will stay on top of this and keep you notified as we see opportunities and challenges and changes that we want to make.
Once again, thank you for joining us on this webcast, and we look forward to continuing our series of these calls with you in the future. And if you missed any part of this webcast, a replay will be available on our website shortly. We really do appreciate your feedback, so feel free to send us an email with your comments to pwm@prestigewmg.com. With that, we all say thank you and have a great afternoon.